Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing a Tractor Supply Company stock. This one came in by request down in the comments section from a Patreon member. And so we're going to bump it to the top of the list and take a look at it here on the channel. As always, this is not individual investing advice. This is just how I analyze stocks. I run a service over on Seeking Alpha called the Cyclical Investors Club. If you join my Patreon group for $5 a month, you can get a big discount there, and those links will be down in the description. So let's get into Tractor Supply. The first thing we usually look at is the history of their earnings, which is really, really good. I'm going to go back to the Great Recession here, see if we had a very minor dip of earnings growth at 9%. If anybody's wondering what these guys do, they don't actually sell like tractors usually, unless it's like a lawn tractor. At least I don't think they do. It's more like acreage and farm type equipment, livestock supplies, things like that. And a lot of times they're in smaller, more rural areas, but not always. So they have a little bit different footprint. If you live in the city, you may have never seen a Tractor Supply. But it's kind of like, I don't know, Home Depot meets like actual Tractor Supply, like ranch supplies and things. Or pet food, I think they even sell there. So let's see. So the high quality, it looks great. All this looks fantastic. COVID, they got a real bump in earnings. And let's look at this here. So we'll go to a more normal time frame that I would use when analyzing a stock like this. Now they had good growth before COVID, but let's call it, this was a tax year, so maybe that's 10%, we'll say, 9 or 10% earnings growth. It was a little faster, I think, before that, if we go back a little farther, right? So a little bit of slowing down here. If you go back a little bit farther leading in, maybe you're looking at like 10% growth, or 10 to 12 maybe. But not super duper strong going in, especially if you take out the tax year. But very solid and always growing. Now, I bought this stock on March 16th of 2020 during the crash. This doesn't have the 16th, but the 13th is pretty close. So I've done really well with this, roughly up in between 200 and 300%. I actually think I'm doing a little better than that because it's one of my better performers that I still hold. I sold most of the stocks that I bought in March 2020. Now, this stock is not going to be a buy now. I'm one of the few people that you will probably find on YouTube that owns stocks, has the price triple, and then tells everybody not to buy it. But the truth is that the valuation here, if you just look on the surface and you ignore everything else, let's call it a 15 PE ratio. Now that it's 50% higher than what it was back then, and we have a situation where earnings are starting to slow down, and they might even reverse. I saw this was one of the most shorted stocks. I don't know if it was in terms of like volume or amount of money. I forget what the metric exactly was in the S&P 500. And my guess is probably because there are people who expect boom bust risk, which I think is definitely here in the stock. Earnings are double what they were. Even if you include inflation, they're probably double what they were before COVID and the stimulus money and everything like that. These guys did a good job during COVID. They had pickup and a well-functioning app, so people could order things online and go and pick them up. So they did a good job benefiting from that. And I think they've done a good job like retaining customers that they might have picked up during that. They also made an acquisition, which I think was I'll have to don't hold me to this, but I think it was like a pet food store chain. So there are some reasons why they could sustain this. Apple is kind of a similar company where I would have expected earnings to fall off more. I really would have expected them to fall off more with Tractor Supply, even though this is kind of a buy and hold for me now. It got right up to kind of the overvalued level where I would consider selling it. But they just don't really have like a ton of like competition, right, in their particular niche that they do. So I just decided to kind of commit to and it never got like crazy overvalued. I mean, 25 PE was the highest it basically got. So the question is, looking forward now, what should we expect? So let's look at the numbers on those. I mean, I definitely think a period of digestion is what we should expect for the next year. Analysts expect that too. It could go on for a while. These earnings could even go down. I say this about other companies. That would probably send the stock price much lower. Now, I'm not betting on that because I'm just holding mine. But because maybe not, they've kind of defied the odds a little bit, or maybe it's just a brief dip. The stock price wouldn't fall far enough for me to buy it at 15 PE like I did before it picks back up again. So that's a reason to kind of hold now. But let's look at the actual valuation. Actually, it's not too bad if you assume what I'm assuming here, which I think is a little optimistic on the earnings growth front. So 14% earnings growth, while not impossible, is probably too optimistic. I would say 9% maybe. That would be more reasonable going forward. And at some point I'll probably adjust that, but I haven't yet. So I would say that I'm being a little optimistic. It is based on what they actually did do. So they did grow earnings a lot during this time period. So it's not that they didn't do it, but the conditions under which they did it were pretty favorable to them. Revenues growing fine. So it all still looks pretty good to me, business-wise. They have a little bit of a debt, so I adjust from a 229 price right now up to 272 when doing the earnings yield. So right now the earnings yield is 3.7% adjusted for that. And so the way to think about this is, if you bought this business for $100, they would earn $3.70 in earnings, that if you owned the business, you could keep it for yourself. I have that growing at 14%, which again, I think is probably a little optimistic. And in 10 years, that gets us to $183. So the CAGR on that is 6.24. So I would consider this like fair value. Now, if I do the 9% earnings growth, now we're right at the edge of like a sell, and a lot closer to where the market probably is, the wider market. So a lot depends on what kind of earnings growth they can actually pull off. I think it's in between. If you took the midpoint maybe of these, it's in between kind of fairly valued to overvalued. It's kind of right in between there. One caveat is they have the ability to pass on inflation costs to their customers. They've shown that they can do it before and during COVID. So if we have higher inflation, I do think this is a business that can pass those costs on. So that's the benefit of taking that extra risk with maybe if earnings growth came in a little lower, then that's the benefit of that is if we get more inflation, these guys can pass that inflation on, and that earnings growth could really be 14%. You know, if market participants are expecting 2% inflation and we get 4% for 10 years, an extra, and these guys make an extra 4% on top of that because they can charge more, that's how you could potentially get up here. So I think probably it's valued similarly to the market, but it's probably higher quality than the average business. So where to buy it at? Using the basic metrics, if you don't think that we could have a recession, I do think these guys will be more sensitive to a recession in in a future recession than they were during the Great Recession. They're a much bigger company. I think their customer base is probably more sensitive to recession than perhaps the last one, because we had such a big commodity boom leading into that. So, I mean, it's hard to say, but I would be cautious. I would be cautious about assuming earnings would only fall 9%. I really think earnings could fall 30% if there was like a recession. So for me, a recession buy price is more like 122, which is about 46% lower. But about 170 if we just kind of don't, if you don't think a recession's coming anytime soon, or you think they'll be more resilient, then that would kind of be like 25% lower than where the stock price trades now, which is 170. So that 170 to 123 would kind of be where I think it's a pretty good value today. And then I like the quality of the company. So that's about, I think it could have a big, if there's that much short interest, I mean, it could have a big sell-off if it disappoints. So investors could get an opportunity. I mean, during this March decline, this was really the type of business that I was able to really capitalize on, because they didn't have like a big dividend yield. They weren't well known among a lot of like retirees that had money, or money managers that were live in cities and never even heard of like Tractor Supply. They hadn't had like crazy growth like some of the tech businesses. And so that was where people were really paying attention. And you're really just able to get a good business at a fair price. That for that week or two, basically. And now obviously people would have done well even if they bought here right now, but they wouldn't have done as well. And Tractor Supply got a little lucky. I mean, sometimes you get lucky. You buy a good business run by good people, and when things happen, sometimes they can take advantage of them and you can get way bigger returns than you deserved, maybe. But a lot of people are getting better returns than they deserve right now. I just think this one is one that you can hold a little bit longer. Okay, thanks for watching. And if you found this useful, hit the subscribe button. And I will see everybody later.